here with Shark Indicators. We've been involved in the NinjaTrader ecosystem since 2011, providing tools like BloodHound and Blackbird that help traders be more productive and in control of their own trade systems. We're always looking for ways to add to the trader's toolkit, and this guest speaker webinar is a part of that mission. Before I pass it off, let's take a quick look at the risk disclosure. Futures, foreign currency, and options trading contain substantial risk and is not for every investor. And of course, past performance is not necessarily indicative of future results. Phil Antonsen develops trading systems for retail traders at Lucrum Trading Systems. He specializes in quantitative analysis and algorithmic trading. He earned a Bachelor's of Science in Finance and Economics from the University of Wisconsin and is a full-time technical trader. So with that, Phil, go ahead and share your screen and we can get started.
All right. Hello and welcome, everybody. Thank you all for joining me here today. And a special thank you to Keith and those at Shark Indicators for hosting this event. My name is Phil Antonsen of Lucrum Trading Systems, and today we will be looking at how to find opportunities during market uncertainty and volatility through the help of automation. So this will include a broad overview of some of the core concepts of automation and how it can lead to opportunities regardless of macro market conditions. And some examples later, we'll be looking at employing the use of Shark Indicators BloodHound, as well as Lucrum Ruby system to build rule-based automated systems that are designed in a way to rapidly respond to cases of extreme volatility and general bearish markets, which are otherwise detrimental for more traditional investments. So the objective here is to help conceptualize and deploy methods which can then be used to diversify and lessen the impact of recessionary periods which would occur on more traditional investment engines. And this is not necessarily meant to be a replacement for your investments that you might have, but is something that you might consider to further diversify what you've got already going on. It's also worth noting that the tools being used today don't require any programming knowledge or experience whatsoever. It only requires a basic understanding of logic conditions, essentially things like, if this happens, do that. Very basic, something that over a weekend you could definitely do a crash course and fully grasp. So with that, in this presentation, the things that we'll be covering, first is how automation can benefit from volatility and general bear markets. Then we'll look at some of the strategies which can excel at traditionally unfavorable market conditions. Then we'll move into building some of those strategies using very simple concepts with BloodHound. And then take a look at how simplicity can be the key and how the very basic ideas in system design can still be the most effective when it comes to raw performance. Then we'll just kind of touch on some of the additional services that we have at Lucrum, including our system consulting services. And then a quick overview of Lucrum Ruby and its interaction with Bloodhounds. Lucrum Ruby, of course, being our flagship product that we'll cover a little bit more in later in this presentation. And at the very end, one of you will be winning a free lifetime license of the Ruby system. All you have to do in order to qualify for that raffle is simply just be here towards the end of the presentation. We'll do a random draw. If your name is called, you'll just simply say something in the chat or in the Q&A box just to make sure that you're here. And then after that, you can send me an email and I'll go ahead and send you everything associated with that. So a quick little blurb about who we are if you're not familiar with Lucrum Trading Systems is that we're a provider of both discretionary and automatic trading tools for the NinjaTrader platform, as well as a trading education and system development consulting company. And our longstanding relationship with NinjaTrader as an ecosystem vendor means that we're a time-tested and industry-leading third-party provider. We've been with NinjaTrader, working with them exclusively for probably close to 10 years now. So our flagship product is the Ruby system, which again we'll be covering in more detail later. We also put an emphasis on our consulting services, which help those like yourself to build confidence in your own trading system through proper testing and deployment assistance. So we're able to provide you with a non-biased outside look at your strategies and make objective observations on them. This is used to help build confidence and to identify any weaknesses or red flags that they might have prior to live deployment. Now, this is very important because there's a lot of nuances when it comes to transitioning from backtesting to live deployment. And we want to make sure that we check all the boxes to make sure that everything is ready to go with as much confidence and certainty as possible in this industry. So a little bit about me. This is a recap again of what introduction was about. So I'm a trader of over 18 years. In my earlier years, I was a hedge fund analyst and trader that specialized in the metals and energy future sectors. I went to the University of Wisconsin for finance and economics, and I'm the founder of Primerial Capital Asset Management Company, which is my lead day-to-day role as a fund manager. And I am based out of sunny Fort Myers, Florida. So let's move on into it. So what are the benefits of going automated? So the first one is the raw speed and efficiency of it. So automated systems can, of course, execute trades in milliseconds, far faster than a human can react. And it's not so much its ability to place that order faster than you can, clicking the button faster. Basically, the real power is its ability to monitor multiple things at once. So if you have multiple systems across multiple markets in a rule-based system, a human will take time to analyze each market and each system to find out exactly when the rules of that system are in play and when to place an order, versus automation can basically look at exactly all the rules, all the markets, and all the systems in play and do it instantly. Next one is, sorry for the creepy pictures, by the way. I made a bunch of AI generated things that sort of makes sense with the slides, but this one is particularly funny to me. So this was the emotion-free trading aspect of it. And automated systems, of course, follow logic and data, not so much the human emotions of fear or greed or otherwise. It also has a consistency because it sticks to a predefined strategy, even during market turmoil. Now I have free in quotes here because it's never going to be completely emotion-free or emotionless, because you're still going to see what's happening. You're still going to see the trades being executed. You're still going to see the trade log, intratrade drawdowns. You're going to see the capital balance and everything like that. That is still going to have weight, so to speak. It's still going to sometimes spark things of, do I need to intervene? Do I need to do this? Do I need to do that? Essentially, don't, for one. If you properly built your systems, you want to make sure that they're able to run autonomously and have the ultimate say in exactly what's going on. But like I said, it's still going to be some emotion, but it's significantly less. One of the big draws that I had with automated trading was this very aspect. So I was doing rule-based trading, rule-based technical trading, and was doing very well at it. But the downfalls was primarily the fact that I was second guessing things. I wasn't fully following the rules. I was having moments where I was like, oh, should I liquidate? Should I stay in longer than I should? And ultimately, they will collectively have a more negative impact on your actual performance. Next strength is the ability to backtest and optimize a system. So strategies can be tested on past data to evaluate performance before risking real money. And backtesting is an extremely powerful aspect when it comes to automated trading, because it allows you to theorize and implement some sort of trading logic and see exactly how that would have performed in the past. Now, of course, the randomness of the future is always going to have a high level of uncertainty, but at least a backtest will provide you with a little bit of semblance of what could and might happen in the future. And it's not so much the speed at which you can backtest. If you were to have a rule-based system and you were going to manually backtest it, it would take you an extremely long time parsing through months, years of data, and it wouldn't be as accurate as you can just by using software. When it comes to automation as well, parameters can be tweaked, they can be refined, all using historical data. That reduces some of the guesswork when it comes to what are the optimal settings for a particular strategy for a particular market. Of course, there's a whole thing with optimization and backtesting. There's a big thing with curve fitting, which I'm not going to get into today. I believe it was one or two of my last webinars with Shark. I did a whole thing about how to properly backtest and optimize. It's worth looking into if you're interested. The next is its ability to continually monitor the markets. It's always active. It can run 24/7, even while you're asleep or unaway. And this is extremely important because the markets don't sleep. And of course, futures markets in particular, they're not quite 24/7, but they're enough close to it. When I was younger, I was actively trading every single major market open. That was, of course, the US, the European, Japanese markets. And my sleep schedule was terrible. It was stressful, sleep sucked, and it had a pretty negative impact on just general physical and emotional health. And with automation, it can be looking for you. It's still going to do the rules that you would have done anyways, but you don't have to be there and watch it. And that also has the global reach. It can operate across different time zones and markets all simultaneously without you having to physically be in there and physically watching it. Next important thing is its ability to scale and further diversify. And scalability lets you handle multiple strategies and multiple markets at once. And through diversification, you are able to run multiple markets with multiple systems, which further reduces the risk of trading because you are more spread out, especially when you have systems that have strengths in different areas and in different market conditions. And if you're, again, doing this manually, you really can't. You're limited into how many monitors you have, how much brain power you have to actually see what's going on and to actually be on top of everything. And it's discipline, and its strategy enforcement is absolute. It eliminates the impulsive decisions and ensures that a strategy adheres to the rules. This kind of encompasses back into the emotion-free trading. It's always going to do exactly what you program it to do. Computers, at least not now, aren't sentient, and they're not going to go against what you have programmed them to do. This also prevents overtrading. It only trades when the criteria is met. It's not going to be chasing losses. It's not going to be chasing hype. It's not going to be doing things that are going to be a little bit more speculative in nature. So why does this actually matter? And I'm sure everyone here is aware of the current sentiment and the general feeling of uncertainty there is in both national and global markets today. And I'm not going to speculate into the long-standing implications or even the near-term implications, what I think it means or what I don't think it means. But what it does do is it illuminates on a general frailness of traditional investments and how quickly things can change. Now, assets which are traditionally deemed as recession-proof or safe during bear markets have also shown cracks in the armor. They've shown a little bit of weakness in their true correlation of balance, which leaves less in terms of true shelter in harder times. So I've been doing this for a very long time, and I've never really been somebody who talks a lot about themselves or anything like that. And people often don't really know what I do. Typically, it's surface level of something. I'm in trading, I'm in finance, whatever. So with that knowledge, I have a bunch of friends and family and acquaintances that know that and will make small talk and be like, "Whoa, what do you think about what's going on? Market's really bad today." And my response is always like, I don't really care. I don't care because I have programmed my systems and I have a balance of different systems in a portfolio with different markets that each system trades that can handle it. It is something where I have more or less become immune to some of the crazy impacts that might be going on. Of course, some market conditions I do better in and some I do worse in. But ultimately, I've done enough over the years to warrant a little bit of confidence when it comes to, super volatile or super bearish market conditions. So that's something that's entirely possible just through proper planning and building out systems that have strength in these market conditions. And we're going to go over them now. So like any good investment portfolio, automated systems are no exception from benefiting from diversification. And automated systems can be diversified not only through the type of strategy each system deploys, but also the markets which the systems trade. Now, each system typically excels at certain market conditions, and this is due to the actual logic of the strategy and the rules that are used to execute each trade. And these will vary to a large degree, but generally each system can be classified on a more or less specific trading type. So now we're going to just look at a few of them and see how they operate, as well as talk about some of their strengths and weaknesses and how they themselves can complement each other, and look at capitalizing on all the different market conditions. So the first one is your classic mean reversion. So these strategies assume that price will revert to the historical averages. So in choppy and sideways market conditions of assumed overbought and oversold conditions, they can be exploited to capture price movement as price moves closer to the mean. Some of the examples of the tools that can be used in mean reversion are Bollinger Bands, stochastic oscillators, as well as a moving average convergence divergence. The assumption is with this is that during sideways markets, when price hasn't really found that equilibrium or really enough momentum to define a trend, there's going to be kind of a sign of conditions where there's a overbought zone where price has gone up, and it's going to eventually, in theory, with this, revert back to the mean. So go back down into the mean level or possibly past into the oversold zone. So if I can do this into that. So right now we have a completely naked NQ. This is just a 60-minute continuous contract that we're going to just be looking at some of these on. And I've just built out a quick template here using a few of them. So actually, let's first look at how mean reversion can be used with a stochastic oscillator. And that's what it looks like here. It's this dual band at the bottom, and essentially what this system is trying to do is define overbought and oversold conditions where you reach past a 80 mark and a 10 mark. So we've got, or 20, I'm sorry. So we've got overbought in the top range and oversold in the bottom. And this is particularly useful in range-bound sideways markets. And in BloodHound, we've got our stochastic threshold solver, and that is essentially just the stochastic. We are looking at the blue band here. It's all just default settings. I'm not going to go into building out systems that are in a best case scenario. It's just basically random period with default settings, just so you can get an idea of exactly what we're looking at. And that just looks like that. So we've got, when the bands are below that 20 mark, it represents a buying opportunity. And when they are above the overbought, it represents an over or a short situation. Now, of course, like any system, it's never going to be 100%. Obviously, as you can see here, these conditions of oversold have continued. And anytime where you've got, oh, it's buying opportunity, continues down. But there are ways to add to that system that filters out some of these. So we're just going to do a quick one here. and that's we're just going to look at the slope of the stochastic. So in theory, once it has reached some level of apex, it's going to come back down. That will sort of signify the start of any type of reversal towards the mean. And to do so, we just add another solver, which looks again at the same stochastic blue line. And we just add a simple slope solver, and we can add a quick AND condition. And we can filter out some of them to try and find a little bit more opportunistic ones. Obviously didn't really filter out that one, but that's fine. This one looks pretty decent. It reached and came back from an oversold into a small uptrend. This one here, again, oversold, came back to a decent uptrend. This one in the inverse, overbought and came back down a little bit. And you can, of course, tailor this a little bit differently if you wanted to do something like a 90 threshold for more extreme cases, you can. And that's just, again, a very simple approach to it into how you can use a stochastic into identifying some of those oversold, overbought conditions. And basically just a couple different solvers and an AND node. There are a few different ways you can approach this as well. You can use look back nodes as well to see exactly when certain points were reached. And again, tailoring it, but for example's sake, we'll just kind of leave it at that. Keep it simple. All right, back to this. All right. Next one we have is momentum. And these strategies capitalize on strong price trends that are often caused by news impacting the underlying asset. And these typically will be faster moving and can spark larger continuation of movement as time progresses or be quickly followed by a correction. Some of the examples of indicators or tools you can use to capture that, one of which is the Ruby system. Another one is the RSI, a relative strength indicator, or varying degrees of linear regression moving averages. So that will do a quick example of that. Where is... So first we're just going to load up Ruby, which is the tool we're going to use to look at this. Get rid of the stochastic. Open BloodHound once more, and we are going to look at two different things. Ruby has what are called trade trigger signals and extended trade trigger signals. And those are based on a number of different factors, which are in turn more or less a momentum-based tool. So we have the red signifying short opportunities, and we have the yellow lines that indicate an extension of the initial signal. So these are called the extended trade trigger signals with Ruby, and then it can be used as a point of liquidation, as a take profit, or an opportunity to scale into a position. So in this one, we've got just again, default stuff. We've got our trade trigger signals, and they look like that. Looks like I must have the settings a little bit different. So if you're not aware with BloodHound and how indicators work with it, if your parameter settings with the indicator are not matched with what is utilized within BloodHound, things won't align perfectly. But that's okay. It looks like we got most of them. So we've got short signal, and this is highlighted. This is why I see that must be a mismatch in the parameters somewhere. And then we got long, long, short, long, short. And with momentum, you're looking at capitalizing on a confidence that the price is going to move in a specific direction based on, again, a number of different metrics of strength and general volatility of it. So with the trade trigger signals, we can start to look at different opportunities when there is a pullback from a specific direction. And generally with Ruby, you have gray bars, and the gray bars are sort of the transitionary periods where price is on the move, but there's not enough strength, there's not enough confidence that the system has of a defined direction until we start developing the magenta or green bars. So here we have the gray bar transitionary into a short signal with a plethora of different extended signals. Extended signals you can see here. So again, just because we're just doing some rudimentary looking at things, this is not designed to be a perfect representation and not something I would say, all right, system's ready, let's launch it, because we haven't really even looked at exit conditions, but that'll have to be for another time. It's just going to give you an idea of what can be used in order to look at different tools in order to capitalize on bearish markets or sideways markets or just general volatile markets. And last, we've got a trend following system. So trend following, I'm sure that many of you have heard the term trend following systems. It was extremely popular because they essentially killed it during the 2008 era when they were the all-stars. They were the ones that made the most because they capitalized on this rather dramatic but prolonged downward trend. And trend is similar to momentum, but generally it's just not at the same scale. Momentum generally can be utilized as a quicker, smaller time frame, smaller ranges, whereas trend is looking for longer time periods. I mean, you're looking at minimals of days holding, months holding, which understandably with futures is not always possible because there is obviously a tremendous amount of leverage, but it's still an important application. But yeah, similar to momentum, trend, or again, commonly referred to as trend following, grasp the anticipation of larger continued price movement over a longer period of time. And they're also non-biased towards long or short. Some examples of that, again, are various components of the Ruby system, as well as things like moving averages, long-term moving averages, like 100+ period moving averages, like the EMA, SMA, or things like the ATR, average true range trailing. Some of the weaknesses are that sideways markets are pretty tough for trend because they often give up a lot of the total run on either side, and they can generally incur a larger intratrade drawdown and requires more capital for overnight holdings. And trend following systems typically incur many smaller losses, which are then offset by substantially larger gains. So even if you have, say you're winning 30% of the time for trend following, it might not matter as much because the winners are going to absolutely dwarf the losers because they tend to get out quicker and they have longer holdings that let the full breadth of the run happen. All right, now we're just going to look at kind of I feel like an important topic, and it's kind of a general concept that is, I think, worth talking about. And that is the difference between reacting to something and predicting something. So there's always going to be a balance between attempting to react to price movement and trying to predict where price will be in the future. Prediction is speculative, meaning that future is completely unknown, despite our best guesses, while reaction adheres to current and past knowledge of known data. And from my experience, designing automated systems, you always require data from the past. I got a drink of water. There we go. So again, from my experience with automated systems, you always require data from the past in order to drive a reactionary response. So once the conditions of a trade have been met, it will still continually analyze current and prior data to confirm if the conditions are still met to maintain that current position or to exit. Now, in any case, the response of the system is a reaction, not inherently predictive. So it kind of sounds like an obscure concept or complicated concept, but in practice, it's really quite simple. Consider a system which simply buys when a price is above a simple moving average and sells when below. The conditions are met by analyzing the past data to determine when price is above that point to buy. And through the entire duration of the trade, the system is continually looking at the condition of, is price still above the SMA? And it never predicts where price is going to be in the future. So prediction or speculation is more of a human trait where one might analyze various things which one might determine the value of an asset and where you think it should be. The problem, however, is that unless the market makers agree with that sentiment, the markets may never come to the same consensus. Now, this concept is the basic irrationality of the market. Despite how much evidence you might have, the broad assessment may not be the same as your own. Now, when I worked at the hedge fund in my earlier career, our approach was more predictive. It was more speculative because we were analysts. We would take a bunch of data and we would try to predict where price was going to go. We were predicting if a particular asset was under or overvalued. And like anything in trading, sometimes it worked well and sometimes it didn't. But ultimately, it sometimes took a long time for our analysis to actually hit the market because people's opinions on different things change. They might look at things differently than you. Everybody has different data, despite having the same, has different interpretations of the same data, I guess I should say. And it might never happen to how you anticipate it would be. So that's, again, the strength of automation is it's reacting to things. And as it should be, it's looking for something to happen in order to make a decision. It's not picking a blind spot and saying, I predict that it's going to go up, I predict it's going to go here, I predict it's going to go down. No, it's simply looking at what already happened and where things are looking in order to have a general consensus of the continuation. Again, it's not necessarily predictive. And a good example is for what we just did, just doing those quick three is simple systems do work. An automated system might sound intimidating to some because people throw on words like quantitative and algorithmic and everyone's favorite buzzword, AI. It makes you feel like you have to have some type of PhD in computer science and mathematics to stand a chance at being successful at it. And thankfully, it's not the case at all. Designing and building a system is easier now than it has ever been, thanks to tools such as BloodHound and NinjaTrader. You can turn a concept into a testable and deployable strategy in a matter of minutes. So this doesn't mean that it's necessarily easy to make a consistent and profitable system, and it'll likely take time to identify certain things that reach the ideal balance of risk and reward. And trial and error is basically the nature of the game. System creation process is, there's no such thing as perfection. It's going to be trial and error, what works, what doesn't work. But each time you're going to see what can be utilized and what can't, what can be implemented in which system and which won't. And ultimately, the objective is to get better through progression and time. And for me, it's a lot of fun. I like building different systems and trying different things, and it's certainly very rewarding, or can be. I've made a very successful career out of it. And I always find the process of going from theory to design to testing to be enjoyable. And every time that you build a system, you will learn new things to improve other strategies you might have built, or to have ideas for completely new ones that you haven't even thought of yet. So I like being able to validate the observations that I have and the ideas that I have to determine if there's actually something that holds a statistical advantage that can then be used to my benefit. And trading logic doesn't have to be overly complicated with dozens of different nodes that become so convoluted that you aren't even sure what it's doing at that point. You'll likely find that some of the most basic logic concepts can be the most effective. I've worked with a number of people that have built out different systems that I have helped consult for or test for them. And I've seen the entire gamut of super simple to overly complex. When you have something that's overly complex, you fall into the trap of curve fitting more because your base logic is going to be the cornerstone. But when you continually adding upon that, adding different filters, you're assuming based on historical data. You're looking at past things to improve it, which the randomness of the future, the past is never going to be replicated, never, ever. And you want to make sure that your system is robust enough to handle the randomness of the future. But if you end up adding too much to it, it sort of falls apart. And one of my early mentors, when I was very, very early on in my trading career, they worked at a larger capital management company. And through our conversations and our talks, he divulged to me that his quant system, his quantitative system, was a simple moving average crossover with an ATR stop. That's it. This is millions and millions of dollars being managed by a fund that has the most rudimentary system possible. And it just shows you how this can happen, massive amounts of capital with success with something very simple. And I don't really want to undermine them and what they're doing because there's more to it. There obviously a lot in play when it comes to diversification in assets, risk management, and allocation. But the cornerstone of multi-million-dollar fund is an SMA with an ATR. So I thought that was pretty wild because I was very early on in my trading days, just getting started into automation, and I was like, no way. I was overly complicating things. So that's the whole mantra of KISS, keep it simple, stupid. So now we're just going to look at the Ruby system. I know some of you are familiar with that. I recognize a number of names in here that are Ruby users, which I appreciate you being here. But for those that are new, basically what Ruby is a visually oriented trading aid, which allows you to quickly and easily identify trading opportunities by systematically analyzing price momentum, breakout ranges, and deviations in price. This toolbox of trading resources provides you with visual cues as to when trading opportunities present themselves. So we're just going to jump back into our chart and kind of see what it's all about. So this is what Ruby looks like when you add it to a chart. It will replace the bar colors with the obviously customizable magenta and green with the intermediary gray bars. And Ruby was developed by me many years ago, over 10 years ago now, because it was a tool that I was building for myself. It was years of different things that I've tried and tested, and I landed on certain things that worked for me. And I just decided to build out an indicator for NinjaTrader, which I was using then and obviously still continuing to use today. And this is what we have. It has a few iterations over the years, but ultimately the core concept is identical to what it was when I first created it. And Ruby itself is leaning a little bit more towards a momentum-based when it comes to the trade trigger signals and the coloration of the bars. It looks for confirmation and movement with obviously more behind the scenes on what it's actually thinking about, but it gives you a much more clear and concise vision of what's happening quicker than most other interpretations might be. And with Ruby, everything is customizable. So right now we have it on a 60-minute chart, which of course for many is a way too long of a time period to realistically think about when it comes to especially day trading. All aspects of it are customizable, mainly with the different parameter settings like trade sensitivity and trend sensitivity, which can tailor it to be more or less reactive to certain things. So if you're in a smaller time frame, you might want it more sensitive for little quick pops in and out. If you're looking for longer holding periods, you can adjust it to a way that shows more defined, and that which turns Ruby into a little bit more of a trend following, where you can set super not sensitive, look for large movements, and capitalize extremely long duration moves versus ones that are more sensitive. So I'm not going to go over a whole lot about Ruby today. I know I have more resources about that elsewhere, but I will show you quick the template that is included with any Ruby system purchase, and that is essentially the template. So all the different components of Ruby It's the bar colors, the gray bars, the extended signals, the entry signals, the linear regression moving averages, the slower moving averages, the colors that are defined by different trend strengths are all going to be something that's measured and being able to be implemented within BloodHound. So you have the template, which has everything from the bar direction, whether up or down. Not going to really go over all of these because they're a little bit redundant. The trade trigger signals, which are going to highlight all the long and short bias signals. And we also have things like the Fibonacci comparison, which is the basically the range pivot. In this particular example in the template is the 50% fib level. And it shows basically whenever price crosses above or below the 50% fib level, which of course is always customizable. As you can see, all of the different parameter outputs in this little dialog box on the bottom right. So again, just quick thing about that. I'm not going to bore you with everything that it can do. Like I said, I've got different videos and resources if you're interested, but that gives you kind of the rough understanding and your ability to build out various automated systems simply using the template as just kind of a kickstart. Again, we just looked at the interactions with BloodHound and the accessible outputs via the template. And now moving on into the consulting side, and if at any point in this process you need help with anything, it's something we'd like to lend our hand to and offer help with, because we offer a wide array of different consulting services that helps you through the entire process from initial concepts of system design to live deployment. Again, I've been doing this for quite a long time, and I have taken my ideas into a managed fund approach over many years. So I've done it. I've done everything when it comes to automation and taking things from the idea to using live money with it. So some of the things that we can do to help is system backtest accuracy testing. When you have a system and you backtest it, you can't always assume that a backtest is going to be accurate, simply because indicators sometimes react differently, bar types react differently to different things, and something that might look very promising might not actually have been so great in the context of live trading. So with that, we can look at a system backtest and compare it to a live test in the same duration, just to make sure that what you're seeing in the backtest is accurate. We also do things such as live level 2 order book testing. Level 2 is basically a live order book that has both volume associated with it, so you can actually emulate what a system would do in a nearly true live environment. So this will factor in things like slippage. It will impact things like the movement of the market in relation to what's going on, which gives you further validity into your testing process. Then we do things like system optimization. Again, having a third party, an unbiased look at your system to do the robustness, just to make sure that you haven't overly fit your system to historical data. We look at different double-blind testing. We look at various market testing and time frame testing, just to make sure that a system is designed with the context that it can handle the more randomness of the future. Then we can help with your tech stack implementation and deployment. This is stuff like virtual private servers, dedicated servers offsite, redundancies in place, which is extremely important because you want to make sure that when a system is running autonomously and something happens, if it double places an order, if the system shuts down, if your data feed's lost, if you have hardware issues, your server shuts down, your internet connection shuts down, and it's running blindly and you don't know it, you want to be damn well sure that you know about it as soon as possible to rectify it, because that's how you end up with a rogue system. And I've seen some things that has lost a whole lot because of oversight. There was one something happened with the system and basically it placed hundreds of trades over the course of several minutes. It's not good. But yeah, things like that is things we want to avoid and to make sure that you have all the tools in place that gives you the confidence when you can actually look away from it, close out the virtual window and let it do what it's designed to do. Another thing we didn't really touch on, but quick note is I also have the Ruby System Trio, which is 3 independent systems that are used with Ruby and BloodHound that acts as the cornerstone or foundation for further system development. These are designed with the intent that the systems are as contra-correlated or loosely correlated as possible, but still give you an idea of where a system can start and how you can build from it. So that includes the Fibonacci extension retracement, MMA, linear regression moving crossover system, and a high-low linear system, which is a range-bound system that looks at previous highs and lows through basically the range pivots form different high-lows that all pretty unique systems. And they're used as kind of like the foundation to build from. Quick note for any of those that might be interested in purchasing the Ruby system, what you actually get with it. So that includes the Ruby system for NinjaTrader. I also have it for NinjaTrader 7 if anybody happens to still be using it, but I doubt it. This also includes the Vision Renko bar type. Didn't touch on this, but essentially the Vision Renko bar type is a non-time denominated Renko bar that is more accurate to actually what happens. So most Renko bars, at least the default Renko bars, assume that price is seamless in its movement, where that's not the case. These will actually represent them accurately, and it's also back testable, which the default bars are not. Now, also it comes with a comprehensive use and trading manual, which kind of breaks down how you can use Ruby in different ways. It has a breakdown of all the different parameters and what the parameter value means and how you can tailor them to fit your needs. Also includes the BloodHound template that I showed you and all the different outputs that are accessible. It helps you kind of jumpstart so you're not having to build your own solvers for every different component. It also includes free updates. Updates are rare. That's generally if there's any huge quality of life things or compatibility issues, or if they were to introduce NinjaTrader 9, obviously updates for that would be free. There's also free support if you've got any issues around, import issues are wrong or something's not quite right. You're having difficulty having your BloodHound template line up properly. Free support is always available, and I'll also be doing a up to 1 hour free setup and consulting for those of you that are here today. And what that does is basically allows you to jumpstart. So I'll do a one-on-one with you, and I'll have an understanding of what your objectives are in your trading, how much time you can commit to it if you're looking for full automation, which markets, which time frames, how long you want to be in the markets, and things like that. So I can help you get a rough parameter setting for you so that you can kind of jumpstart that whole learning curve. Basically the same with the 3 system package. It's for NinjaTrader, of course. It's all open logic, so you can see in the BloodHound template that's provided everything what's going on, so there's nothing kind of behind the scenes, so you're not sure exactly what the systems are doing. And that includes documentation of each of the system's operations, and how they can be used, how they're strong, how they're weak, and everything in between. And again, free updates, free support, per usual. And then today we'll be doing an offer for both Ruby and combos with Ruby and BloodHound, and that will be available on lucrumtradingsystems.com/webinar. And I'll put that here in the chat box here. But with that, we have the promo code, which is SI Shark Indicators Webinar 06, and you can claim $100 off either Ruby or a combination of Ruby and BloodHound. which is the best deal that I offer for the year. I've been contemplating for a while now whether or not to increase the price of Ruby, and I believe that I might heading into next year. So this is actually going to be the very cheapest at $4.95 after the $100, or no, $3.95 after the $100 off. So there's that. And that will be valid until the end of April.